Hey everybody, welcome back to Chipstock Investor. We have a great episode for you today. We've been fielding a ton of questions regarding the trade war and tariffs. These are rightly concerning questions because with a re-elected official going into office and some of the economic policies that he had the first term. So we'll address some of those questions because we have a ton of research on the topic because we were actually invested in chip stocks when the trade war began 7 years ago, not just today.
Yeah, so we've been doing some digging in our old notes, updating things, taking a look at assumptions for the next 2 to 3 years, and we're going to hopefully answer the question for you. Are chip stocks, are semiconductor stocks toast because of Trump getting reelected and implementation of new tariffs, heightened trade war, all that good stuff? One of my favorite topics. I love talking about politics and investing. Super excited.
We're going to try to make this exciting. We just heard on one comment that we sucked the life out of the room. So
I'm sorry. I think I just did it again. I sucked the life out of the room.
let's define a couple of terms that you need to know before we start. The first term that you need to know about is trade war. When we say trade war, that is in reference to the US-China trade war, or the more tense economic relationship between the US and China that started in late 2017. This was early in President Trump's first time around.
And the second term is tariff. You've probably gotten a great definition of what a tariff is over on TikTok already, but just as a reminder, usually this is in reference to an import tariff or an import tax. This tax is placed on a product by a country, in this case the United States, on a product that is manufactured in another country. For example, on a product manufactured in China.
Here is a timeline of the trade war, a new era of protectionist tariffs that has actually been going on for the last 7 years, unbeknownst to many consumers. Again, we're looking at this through the lens of the semiconductor market because we are chip stock investors, and this is measured through SOX or SMH ETFs.
So we've zoomed in specifically on the first half of the trade war, or maybe we should say the first round of the trade war that lasted from 2017 to the end of 2019, that period of time, the end of 2019, early 2020, when we forgot about trade wars entirely and instead shifted our focus to COVID-19. How does that phrase about investing, how does that go? Investing is all about going from one damn crisis to the next, something like that.
We certainly did that.
Yeah. Anyways, as you can see, in spite of the trade war starting, at exactly the wrong time for the semiconductor industry, at the peak of a growth cycle and the start of a new down cycle in 2018. These are just natural cycles for the semiconductor industry. Chip stocks actually did just fine. You can see there was definitely an exacerbated effect on chip stock prices in that period in 2018 during the downturn, but most of that really was not so much the trade war and the threat of tariffs, even though the media did a great job keeping us all fixated to the media, to our screens, looking at the latest updates on the trade war. What was really actually happening behind the scenes was just a natural down cycle for semiconductor end market sales before a new growth cycle began at the beginning of 2019. All along the way, you would have done just fine if you just held.
So the question is, are we headed for a repeat in 2025 and 2026? If you want the Reader's Digest version or the TLDR, which I just recently figured out what that is, the answer is probably not. This, of course, depends on the timing of any changes as the new administration goes into office, and it depends on those policies that they make or change. However, the last go around when the trade war started, the semiconductor industry was actually at a cyclical peak. This go around, most of the semiconductor industry is not at a peak other than AI infrastructure, which has been in max growth mode, but the rest of the market has been just coming off of a long downturn. History will probably not be exactly repeated, but there will be some things that rhyme.
Okay, hey Casey, but a lot of people are probably here wanting to know about tariffs and what that means for their chip stocks. I understand. We understand, we get it. Tariffs are concerning, regardless of which product, which manufactured good the tariff might hit. Tariffs are a tax, and higher taxes are generally agreed upon to negatively impact consumers. That tax, the cost of it is just passed on to the buyer, the ultimate buyer. However, this is a big however, because we're not political commentators here, but we just want to present some actual investing facts for you. Did you know that Trump's tariffs have actually been Biden's tariffs as well for the last 4 years? The outgoing administration actually left most of Trump's tariff policies that were ultimately implemented back in 2019 after multiple delays and deliberating about how they would happen and renegotiating of trade deals with China and the EU and so on and so forth. Most of them were imposed in 2019, late 2019, early 2020, and the Biden administration left them in place. They have actually already been going on for the last 4 years, and they were set to expire 4 years later, which is why in May 2024, the Biden administration reviewed and renewed, or in some cases expanded on those tariffs. We have a link to this White House press release outlining some of these updates back in May. Link here in the video, or you can access all of our show notes, including these show notes, over on Semiconductor Insider.
So the tariffs we're specifically talking about are these Section 301 China tariffs. Those were the ones that have been extended after the 4-year review just in 2024, and that includes manufacturing equipment, parts, and related components. The primary target of these tariffs, as it pertains to the semi industry, have been on semiconductor wafers that are manufactured in China. Mostly that's geared towards things like industrial power equipment, automotive, and other so-called legacy or mature chip manufacturing processes.
So the point here, once again, remember, we've already been dealing with these tariffs for 4+ years. And also bear in mind that these tariffs are in addition to the various export restrictions that have been in place on advanced manufacturing equipment like ASML's EUV lithography machines and other advanced AI chips like what NVIDIA produces. These tariffs are in addition to export restrictions on these things to China. So it's really been a double whammy for a number of years now for a lot of semiconductor businesses, dealing with higher prices because of the tariffs, the taxes, as well as having lots of hoops to jump through if they want to sell certain items that get an exception for export to China. There is an exclusion process. We, again, have a link to that as well here in the video or in our show notes.
There's also a great timeline of events from taxfoundation.org. But the point you should take away from all of this is we've been living with tariffs all along. So the concern is actually whether these tariff policies will change, not if they're going to become a thing. They already have been a thing.
Yeah, and we've already said we've already eaten this collectively as consumers, but you can see this data collected by the Tax Foundation. It hasn't been completely catastrophic. Has it been a headwind, especially for certain industries like the semiconductor industry where there are lots of global trade routes? Yes, it has been, but we've all been able to deal with it up until this point. So some of the doom and gloom being pitched out there right now is probably a little over the top. I don't know that we need to be concerned about worst case scenario here just yet, because we don't know what kind of changes are going to take place, but this seems like a manageable thing. Let's see how this all pans out.
Before we talk about how some of the specific semiconductor companies weathered the trade war the last time around, let's talk about our personal finances a little bit with a word from the sponsor of today's video, public.com.
As you know, the Federal Reserve has been lowering interest rates again, just a little bit. We had a very small cut so far, and longer term, if these interest rate cuts continue, that can impact the fixed income portion of your portfolio. But thanks to companies like public.com, you can lock in a higher yield utilizing a bond account. In fact, as of this writing and recording of this video, public.com's bond account yields about 7% annualized yield. Not too bad. I'd say that's a pretty good yield on a fixed income portion of your account. Much better than you would have gotten in the 2010s, that's for sure.
It's quick and easy to get set up with your new account at public.com/CSI. But make sure you do it quick because your guaranteed rate is not locked in until you invest. Check out the new bond account from public.com/CSI, link in the description below. Let's go back to the start of the trade war in late 2017, which corresponded with a cyclical peak in growth for semiconductors. Here's a look at Micron, one of the most cyclical businesses, and Intel, which was a former bellwether of the industry.
What we have here is revenue from late 2017 until 2019. You can see both companies obviously took a revenue hit starting in 2018. Micron, especially so, went down and stayed down for a while. Intel actually snapped back relatively quickly. And despite the constant media coverage of the trade war exacerbating the actual stock prices of these companies, as you could see earlier in the slide, in SMH and SOXX, the two semiconductor ETFs, the businesses themselves were able to manage this double hit from both the natural down cycle of the semi industry and the trade war.
This is Micron and Intel again, this time with their operating margin at the beginning of the trade war. This is where you'll want to focus your attention as we enter 2025. Not all semi businesses are created equal. Some will outperform in cyclical growth as a new cycle begins.
Yeah, and you can see that illustrated here during the last downturn and then coming out of the downturn in 2019. Some companies just rebound much more quickly. And this is the case this go around as well. Micron stock, the actual stock price is a bit of a different story this go around, but just looking at the operating income itself actually has performed very similar this year as it did back in 2018 and 2019. The margins just take longer to rebound for some businesses than others, and that can have a big impact on the ultimate stock price in the next, let's say, 2 to 3 years.
Let's now shift our focus to a couple of manufacturing equipment suppliers, ASML and Applied Materials. It's the same story for Applied Materials and ASML, which we could argue are especially well-built business models to weather the entirety of the semi-industry cycle from peak to bottom. Even the specialist ASML had a couple of quarters of beaten up operating margin, but quickly rallied back to all-time highs.
Good stuff there with ASML and Applied Materials. Great all-weather businesses to hold for the long term. One more different portion of the semiconductor industry supply chain. Before we talk about the supply chains themselves, TSMC, of course, the new industry bellwether for actual chip manufacturing. TSMC is still kind of an emerging business. Many investors were not aware of this business. It hadn't entered widespread public consciousness yet back in 2017 and 2018. It has now, but you can see once again, very similar story back in 2017, 2018. During the downturn, TSMC actually did quite well and then quickly returned back to all-time highs in 2019. We had been expecting something similar for TSMC as it exited the downturn early, kind of riding NVIDIA's coattails with the accelerated computing boom. But as the rest of the semiconductor industry also comes out of its downturn, this is also going to be a big benefit for TSMC. But we do need to be mindful of a potential trade war and tariff impacts that might hit TSMC this go around that it maybe was able to skirt 7 years ago. At least that's kind of what has been indicated by recent comments from President-elect Trump. Okay, so there's a look at some specific companies. Hopefully that adds a little bit of historical context. Let's talk about the supply chains themselves now, and what exactly is the point of these tariffs in the first place?
Well, the real point isn't to raise tax revenue for the government. The US government doesn't necessarily need tens of billions of dollars in tariff income. The real point is to affect supply chain change in the hopes that it will favor the US economy. What do we mean by this?
Hopefully you're familiar with our semiconductor industry flowchart. Here's a little bit different take on that. This is a map version of it, so to speak. This is one example of just one semiconductor supply chain, a hypothetical on a smartphone chip. As I say hypothetical, but this is in reality kind of based on what's actually happening. These are the steps in these chips' globe-spanning journey. They start out as silicon boules that are grown and then cut into wafers in a place like Japan. These wafers are then shipped across the ocean, maybe to a fab in like Arizona, let's say, and are developed and then diced into chips. Those chips are then sent back across the ocean to Southeast Asia, where they're tested and packaged. And then those packages of chips are then assembled into a final device like a smartphone. And then the smartphone is then, of course, sold to consumers all over the world, like in Europe, North America, and so on and so forth. This is a sand to smartphone representation of that journey and the supply chain along the way.
And so a tariff on foreign products, in this case, maybe test and packaging, would be to reshuffle the supply chain to countries more friendly to the United States, like maybe in Southeast Asia. And this, in fact, has begun with some test packaging and assembly facilities getting relocated from China to countries in Southeast Asia, like Vietnam. Here's another hypothetical of tariffs and new protectionist policies, this one for AI server chips. Much of these supply chains have been localized to places like Taiwan and Southeast Asia. The US would like some of that wafer production moved back to the US.
Yeah, which is some of the work that has been ongoing already with TSMC building those new facilities in Arizona to move some of those wafer developing steps, I should say, perhaps to Arizona and elsewhere. That shuffles around the supply chain a little bit, but ultimately, most of the final device assembly still takes place in Southeast Asia. So this is still going to be a globe spanning supply chain. Localization is only happening on a limited basis at this point, and further tariff activity would potentially be affecting more change like that.
How about one more example? This one is for maybe Europe's auto industry. A similar chart could be made for Japan's automaker industry too. The US tariffs might try to encourage automotive and power chip production back to the US, or at least for automaker assembly plants to get relocated to North America.
Yeah, and another wrinkle to all of this, in addition to the US wanting maybe more auto production happening in the US itself, could also just be protectionist policy, as has been stated by the Biden administration's revamp of the tariffs earlier in 2024. The tariff specifically that hit electric vehicles was to protect the US's auto industry from low-priced EVs made in China. Europe did something similar as well. So there's a lot of layers to these tariff policies depending on what part of the supply chain they're hitting. But when we're talking about semiconductors, this is possibly what we're talking about. Trying to get more manufacturing redomiciled in the market that will ultimately consume those chips in a final product like a car.
There has been some change that has been affected. Supply chains have responded to US tariffs by beginning to move out of China, but that hasn't necessarily meant a move back to the United States. Chip packaging, for example, has been moving from China to countries in Southeast Asia like Vietnam, Malaysia, and other countries.
So we're just going to reiterate this, I promise, just one last time. The question now isn't what will happen if tariffs are imposed. The question really is, how will already existing tariff policies in place be changed or expanded upon? So will other countries besides China get targeted by tariffs? Will other parts of the supply chain outside of semiconductors get hit with tariffs? At this point, we're just going to have to wait and see. We don't know yet, but we are at a different place in the economy now than when all of this policy initially rolled out about 6-7 years ago.
You may recall we did a video about Ubiquity a month or two ago. If you haven't seen it yet, go back and check that out. We'll link it right here. We illustrated the challenges that some companies face in the supply chain.
Yeah, so in the case of actual wafer manufacturing, these are typically going to be the third-party fabs for companies like, let's say, Qualcomm and Broadcom that manufacture the wafers that get diced up into chips, if those fabs are located in China or Southeast Asia. One of the big questions I think we need to think about going forward is, how do other companies that purchase those chips after they've been packaged up, how are they going to get affected? So like Ubiquity, for example, makes networking equipment, and they utilize a different set of third-party manufacturers, third-party assemblers, OEMs and ODMs, also located in places like China, Vietnam, Southeast Asia in general. How could a company like that get impacted by a new round of tariffs on these products that are actually assembled. Is the end product still going to be considered something coming out of China and Vietnam, even if the chips themselves were maybe manufactured somewhere else? These are answers to questions we don't know yet, and we don't know what exceptions can be made for businesses like that.
Here are the potential challenges facing Qualcomm and its packaging contractors located in China. The chips themselves may have been made outside of China. So if they're assembled and tested in China, which is typically a low value commoditized service, is it really a Chinese product? Again, we're going to have to wait. Time will tell. But we believe many of these chip stocks already are reflecting some of these risks.
Absolutely. They are definitely reflecting some of these risks. Now, here's another one not mentioned on the last chart, monolithic power systems. A similar story for a different company, this one a power chip design business, which we've had lots of discussion about over on Semi Insider in recent weeks. All of the talk has really centered on this NVIDIA Blackwell power chip supply coming from monolithic power is at risk. This is really a silly thing being perpetuated by an analyst that we think was just trying to make a PR move, and it worked brilliantly for them. The real risk that we've called out all along for a company like Monolithic Power is how could changing economic policy hit their supply chain? Because much like Qualcomm and other companies, they send the chips to places like China and Southeast Asia to be assembled and tested. Will those chips that are getting assembled there get hit with some sort of protectionist policy to try to affect the movement of those services out of China and to a different market? Per usual, the media is doing a fantastic job in typical fashion of distracting you, the investor, from the bigger picture that you actually need to know if you're going to make good, rational, well-informed decisions. Last pitch for Semi Insider for today. Check that out for more nuanced discussion on what's happening with companies like Monolithic Power Systems.
Let's zoom out and look at the bigger picture. Are tariffs and the next round of the trade war game over for the chip industry? Simply put, no, it's not. But if you haven't been already, it's going to behoove you to double down on quality, on the best of the best, if you want long-term gains like the ones displayed in our chart from SOXX and SMH.
Yeah, it's been an incredible 7-year run in spite of a tremendous amount of disruption for this industry, a trade war, a pandemic, a Fed rate tightening cycle, a prolonged downturn for most of the industry, and now NVIDIA kind of dragging semi sales kicking and screaming back up again. Even if you just bought the index, which does tend to be higher quality because they're mega cap and large cap semiconductor stocks, you'd have done quite well over the last 7 years in spite of a lot of noise.
Make sure you sub to the channel. We really appreciate that. And hit the like button for us so we can reach more viewers. We've got much more coming your way here at Chip Stock Investor. We'll see you again very soon.